Good morning. Maybe I should state the dates on these things when I'm doing my recordings. Um, yeah, so today's April 20th, 2023. Ken Creager from Black Swan Financial Advisors. Thank you for joining. And my disclaimer, all videos are for educational purposes only. Any specific examples are for educational purposes only. And there are my websites, my YouTube channel, an email in case you want to contact me. Please just send me an email. That would be great. And I named my podcast uh, Black Swan Breakthroughs Financial Strategies for Thriving Through Life's Unexpected Turns. And I do financial planning for everybody, but I specialize in working with families with special needs or with children or family members with special needs. You might have seen my other videos. I have an adult daughter with Down syndrome, and so that's my passion. And there's a lot of things to learn and do when you're in that type of a situation. So please share Black Swan with your family and friends, especially if they have a family member who has a developmental disability or is going to need help, especially after their parents pass on. So anyway, the podcast, I like to cover topics that you know might come up from day to day and week to week. So talk about the latest economic news and investment strategies and so forth. So today I wanted to talk about, we're kind of in a unique situation. We haven't been in a similar situation for 40 years. And most people's financial situation has probably been adversely impacted by the last year or so with high inflation, high interest rates, the activities of the Fed. Um, Everybody's expenses have gone up. I know paying $5 or $6 for a dozen eggs, that's ridiculous. So, and actually, gas in my area, I got gas yesterday for $5.19 a gallon. And that's super frustrating when just a little over 2 years ago it was $2. Okay, so that to me is more than 100% inflation in a little over 2 years. So that's a killer. So, um, but this is actually a time that you can take advantage if you do some things in 2023. It might be 40 years before you can take advantage of similar situation because the Fed's actions in these interest rates, since 2006 or 7 or so, interest rates have been so low that you haven't been able to lock in low risk, half decent yield returns. Okay, so this is something that you can do, and please contact me. We can talk in more detail about specifics, because this video is not going to be super long or super detailed, but basically you could fund your retirement 10, 20, 30 years down the road by things that you do today. Okay, so we're going to talk about interest rates, which are really the cost of money, right? And the Fed has been driving rates up to increase the cost of money to try to get people to stop spending. People don't get rich by getting those 10 baggers or those 100 baggers or GameStop. There are a few people that have managed to time things perfectly and get rich, but probably 95% of everybody else has lost all their money. So the way you build real wealth is over time, trying to get to the point where you can get that 10 to 12% return every year, year after year, lower risk and lower anxiety, right? And especially when you're getting close to retirement or in retirement, or if you have family members with special needs where you need to make sure that your money's going to last 40 years past when you die. I can't afford to have it. Last year, bonds were down 34%, and the stocks were down 25%. Actually, I was out, so mine were actually up. But lower risk, stable, boring companies that have ever increasing dividends. So again, the cost of money dividends. So some really good companies with really good dividend history, you can finally get into them and make a decent return. And it's kind of interesting. Most people don't know this, but if you look at the average return over time of the S&P 500, more than 40% of it is dividends that have been paid by the S&P that got reinvested. So 40% of the return is actually from dividends, not from capital gains. And then in times when interest rates are kind of high, and especially when interest rates are probably going to start going lower sometime in the next year or something, or they're going to pause, then 60% of the returns are related to the dividends that get paid, not to the capital gains. So this is a story that was really fascinating to me. Mr. Pat in Quincy, Florida in the early 1900s, even during the Great Depression, right? He said, even during the Great Depression, people buy a Coke. And so during that economic hard time, similar to today where some companies' prices have gone down, he was able to buy Coca-Cola for $19 a share. So he bought shares of Coke. He convinced a lot of other people in Quincy, Florida to buy shares of Coke too. And he encouraged them to hold those shares through all the ups and downs and everything. Just within 20 years or so, in the 1930s, okay, if you would have bought one share in the 1930s for $19, that one share is worth more than $1 million today. But the thing is, the dividend that share would collect every quarter, every year is huge, and so the returns are huge. And so there were 67 Coca-Cola millionaires from Quincy, Florida in the 1940s. So how does that work? Let's talk a little bit about Warren Buffett. Everybody loves Warren Buffett. He says you need to buy businesses instead of stocks, and you need to think in the long term. And when Berkshire completed its purchase of Coca-Cola in 1994, they bought 400 million shares, and the cost was $1.3 billion. Okay, well, the cash dividend back in 1994 was $75 million. Okay, well, in 2022, it was 700 million, just the dividend. Okay, so $700 million dividend on a $1.3 billion investment. Okay, that's how you get rich. Okay, that's more than a 54% yield on cost. So that's what we're talking about. You need to find companies that pay dividends and have been paying dividends for a long time and are ever increasing their dividends. So let's look at Microsoft just quick, okay? I'm running out of time. Yield on cost, what you pay for it 10 years ago or whenever you bought it, and you hold on to it 10, 15, 20 years from now, and you're getting a dividend, right? So in Microsoft in 2011, it was about $25 a share, and the dividend was 64 cents, and it was a 2.6% yield. Today, the price is $285. The dividend is $2.72. So the dividend is paying you every single year. Now think about this, if you're in retirement, you're getting almost 11% every single year from this share that you bought. Plus, you get $260 of capital gains. Okay? Huge, huge return. Okay, here's a chart. This kind of shows you the dividend goes up every year, every year, every year. Okay? So what you want to do now, because of interest rates, because of the Fed's actions, because the market went down last year, you've got really strong dividend paying companies that will be around 10, 15, 20, 30 years from now, paying a dividend that they've been increasing every single year for a long time. Okay? So here's just some, You want these boring, rich companies, stable companies, and the longer the history. I mean, there's companies out there that have been paying a dividend every single year for 100 years through the Depression and everything. Okay, less stress, less anxiety. Here's just some examples. I showed you Microsoft. Procter & Gamble's been paying a dividend for 51 years. Home Depot, 34 years. Walmart, 49 years. Coca-Cola, 59 years. Okay, so anyway, thanks for joining. I appreciate you listening. I hope this was valuable. I would encourage you to take advantage of the current economic situation because we're kind of in a unique place right now because of the Fed's actions and everything, right? And I've started to do some of this myself, companies that I've been watching. Again, the Home Depot, McDonald's, companies that have been paying, Johnson & Johnson. Some of these companies have been paying dividends for many, many years, and their prices have gone down, so you can get into them in 10, 15, 20. You're just going to hold these forever. And when you're in retirement or, 15, 20, 30 years from now, you're collecting 10, 11, 12, 13% dividends every year on your cost, your yield, based on your cost, that new dividend 20 years from now, you're making a good return. So anyway, thanks. Educational purposes only.